I wanted to make a few opening comments before I invite John Larson up to be our first presenter. And this is the first time in about 5 years I've used this as an opening slide that says the banking market is improving. It is, and it's improving pretty significantly as banks' credit quality has improved, banks' capital ratios have improved. Our banking system is certainly the healthiest banking system in the world, and that's not an understatement. I mean, it's absolute fact in way of both earnings, capitalization, management depth. And this slide is one of the traditional slides from the Fed. Mike Packo was here, formerly the St. Louis Fed, and Mike knows these slides very well since he helped make sure they were done properly when he was there. But this is the commercial and industrial loans at all banks, the percentage change from a year ago. And you can see that C&I loans, these are loans to business. These are not commercial real estate loans. These are not loans to individual for cars. These are not speculative land loans. They're growing at over a 10% annualized pace right now. And that's a major recovery. And 10% loan growth annualized in this country would be huge. I mean, that's 5 times the inflation rate. That's a fairly significant increase in commercial and industrial loans to business. Likewise, the area hardest hit during the 2007 and beyond downturn was the commercial real estate market. And real estate loans at commercial banks are now back above zero in their annualized growth rate, having fallen consistently really since the summer of 2007. When banks got into trouble, what they were asked to shed was their exposure to commercial real estate in order to raise their capital ratio, and that was done in a massive scale, particularly in the southeast United States, Florida, Arizona, California, and some other markets. So what does this mean? I mean, we've been faced with this unbelievable Federal Reserve policy of zero interest rates since the first cut in late 2008, and it's really literally gone to zero, and that has allowed some banks, as loans have repriced, to lower their deposit costs, lower their borrowing costs, and maintain their margin out there in the commercial banking industry. But if you've watched the 10-year Treasury rate, you've seen interest rates move up fairly sharply since the end of the year, about 40 basis points on the 10-year Treasury. The 10-year Treasury is a major benchmark for a lot of things that are priced against it, such as the home mortgage industry and other commercial loans. But this chart shows you what the futures market is saying about the Fed's policy. It's a little hard to see. It's up on our website this afternoon if you want this chart. The 2 lines that are sloping upward, this is the future price of a move in the Fed funds rate, which is what the banks borrow money between each other, which is right now really zero. It shows around 10 basis points there where the blue line ends. That's, for practical purposes, zero. So it costs nothing for banks to have money out in the Fed funds market. But this shows you the expectation of the futures market on interest rates going up, which is the $60,000 question for both borrowers and lenders. And this is where I think the next crisis will be in our economy will be in when that interest rate goes up, and when it goes up, how sharply will it go up? And it's a real concern to loan committees. It's a real concern to people who borrow money on a long-term basis. And this is showing the curve shift outward to 2015 before you see an interest rate increase from up to about 60 basis points on the Fed fund rate, which is a 5-time increase. But it shows that the curve shifting out when the Fed announced that it would not raise rates until unemployment got down to about 6.5%. My view of that is that's a bad idea to put a hard number in, even though the Fed says they don't have to follow the hard number. They still put it out there. They made it a public pronouncement. The Open Market Committee voted on it. The Board of Governors approved it. And, I'm not sure we'll see that number anytime soon. And to automatically say that one is not going to increase rates if rates need to go up because of that, I think is a mathematical error that they will regret. All of us who've been in the bond market a long time remember the last super shock that we had. I see Mark Millsap and Greg Hart's nodding, and that was in the 93, 94 time frame when rates went up sharply. Orange County, Texarkana, Texas were two of the more notable big bond problems at that period of time. So, you know, my view is that rates will go up before 2015, but we don't know when. And it's a challenge for every commitment committee in the investment world on deciding how much risk they want to take on that interest rate curve. But the futures market is not indicating that. And the futures market, Sean Barron would tell you, is a lot more intelligent than the CEO at Delta Trust. So you can tweet that at hashtag IOC 2013. And with those comments, I've got one final one, which is just to leave you with the thought about our performance during the crisis years from 2008 on. Here's our loan growth 2009 through 2012, and our capital growth 2009 through 2012, and the national averages for banks our size across the country. And I'm proud of our team led by Chris Roberts and Carol Pennick and all the people that work so hard for us at Delta Trust and our shareholders, and proud of their results in producing an excellent return on equity you see at the bottom of the page, and the loan growth that produces that. So my hat's off to you guys.